The world's first known inflation-indexed bonds were issued by the Commonwealth of Massachusetts, 1780. They were invented to deal with angry U.S. Army soldiers, who saw their pay erode in high wartime inflation. But the idea of indexed bonds was abandoned as soon as high inflation passed and remained dormant until the 20th century. Is this asset class relevant to you? Yes. Our account of the world's first inflation-indexed bond starts with its context: Massachusetts in the Revolutionary War. As told by scholar Robert Schiller, Massachusetts had chronic inflation problems persisting for almost a century by the 1770s. Where did high inflation come from? As seen here earlier, it came from unhinged paper printing to finance wars. Massachusetts was no different. Queen Anne's War drained Massachusetts, which issued paper money to pay soldiers. But the public faith in the paper money declined. By 1743, the governor of Massachusetts noted that the currency had gradually sunk from 40 to 440% below sterling in 30 years. But inflation was about to get even worse, as Massachusetts attempted but failed to invade Quebec. Unable to pay its soldiers, Massachusetts printed bearer notes, which circulated as paper money. These bearer notes were not redeemable in specie and sold at a discount. Robert Schiller continues. Inflation worsened. Massachusetts issued more paper money to pay for its part in the Revolutionary War. The state could not raise enough money through taxes to pay for war, and soldiers were again paid in bearer notes that they were forced to sell quickly at a steep discount. Wartime inflation meant that soldiers were cheated by inflation out of their real pay, a situation that discouraged their willingness to join the army. Inflation exploded, as seen here. In a folly seen many times in history since then, the Massachusetts Act of 1777 attempted to deal with the problem of inflation by fixing prices. The act gave a list of prices measured in Massachusetts pounds of 50 commodities in Boston. Unsurprisingly, the price-fixing policy was disastrous. It substantially shut down the market for these basic needs and was quickly abandoned. Some other expedient would be necessary to assure fair compensation of soldiers. Robert Schiller notes that, by the late 1770s, as the first inflation-indexed bonds were on the drawing board, the U.S. War of Independence was in a difficult stage. The morale of the U.S. Army was low. They were poorly fed, poorly clothed, and often sick. There were actual mutinies in 1780 and 1781. There was real concern that it would be impossible to keep an army if something were not done to address the inflation problem. In a great example of how necessity is the mother of invention, the creation of the world's first known inflation-indexed bonds came in response to a very real and dangerous crisis. In 1779, the U.S. Congress called upon the states to take measures to assure that its soldiers were fairly paid. Next, the Massachusetts legislature established committees to propose solutions. The work of these committees led then to the creation of the indexed bonds. As shown here, the world's first known inflation-indexed bond is dated January 1, 1780. It specified that bondholders would be paid according to an index of commodities, including corn, beef, and wool. The soldiers were given the inflation-indexed bonds, divided into 4 equal parts. Those who enlisted for the rest of the war were given shorter maturities in notes maturing from 1781 to 1784. As the Revolutionary War was won, there was clearly no more need to recruit soldiers. What happened next? Robert Schiller explains that the world's first inflation index bonds were quickly retired. A 1782 act called for the consolidation of Massachusetts debt and the replacement of the inflation-indexed bonds with new specie securities. The consolidation was complete by 1786. Inflation was by no means gone by then. The state simply decided to do what was better for state coffers. After the Massachusetts experiment, the idea of indexed bonds remained dormant until the 20th century. The first country to introduce it was Finland in 1945. Many other countries followed suit throughout the 20th century, as seen here. Our verified sources are shown here. We encourage you to tell us if your interpretation is different, or if you'd like to suggest other verified sources. What do these tell us? The world's first known inflation-indexed bond appeared in Massachusetts, 1780. Is it possible that a similar case may lie hidden in the records of other geographies, whose early histories have not been studied as much as the one of Massachusetts? Yes, it is. But this does not change the takeaways for you. Our takeaways focus on inflation. Today, inflation-indexed bonds are good tools for anyone interested in protecting their capital against creeping inflation, which may not harm you in the short run, but certainly will over time. Think about avoiding death by 1,000 paper cuts. On the other hand, inflation-indexed bonds will not protect you from hyperinflation or from fiscally irresponsible issuers. Would you buy inflation-indexed bonds from Venezuela or Sudan today?
Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.